We're up and going. So, John, we'll now turn it over to you. Thanks a lot.
All right, we're audio issues this morning, so hopefully there won't be too much feedback, even though I hear it. Cotton prices continue to be volatile. Had a big slide in the spring and summer, a bit of a recovery in August, and settled into the lower 70s range. Part of what caused the sell-off, shorting, speculative shorts, which they've begun to back out of those positions, cover those positions. And that's what's caused a few cents rally back up to 73, 74. The question is, will that continue? And nobody really knows. Fundamentally, things appear to justify the somewhat low prices that we've been seeing, in that we have ending stocks around 4 million bales, and that's more than the previous year. Hence, we would expect lower prices. Some things going on in the world. Despite trimming the U.S. crop size and damage from hurricanes and other problems this year, the U.S. is slated to produce a little over 14 million bale crop. Australia's got a good crop. Brazil has a good crop. China has a good crop, by all accounts. The only one really having a troubled times would be India and Pakistan.
Hey, John, we just had a comment that if you might turn off your computer speaker, can you do that?
Okay. Sure. How to do that?
That sounds better.
Okay.
Great.
All right.
Thanks, Boone.
Yeah, whoever suggested get the high grade for the day.
That did change your slide outlook. I'm going to go back to, there you go. We're back on track. Great.
Okay. On the demand side of things, we're watching several things. Last year, China bought 4 million bales of cotton, including a lot of U.S. cotton, and they stuck it in their government reserve. Well, now they're sitting there holding that. So the question is, are they going to import 4 million fewer bales this coming year? We don't really know. Are they doing that for strategic reasons? Are they getting ready to invade Taiwan and they're preparing for not being able to, import? I hope not. I really, really hope not. But my bigger point is nobody knows quite what they're going to be demanding for imports, because they have a nice 4 million bale stock of fresh bales that they could use if they wanted to. So that's a big question mark. Meanwhile, the regular demand picture appears to be kind of slow, what we call hand to mouth. The mills are not inquiring that much of the cotton merchants. They're just buying a little bit at a time to get them by. So it's been a rather slow pace of export sales. We get those export sales reports every week from USDA. The merchants turn in their sales to USDA. USDA reports it lagged 1 week, and that's basically our picture of demand, and it's a slow picture. So I think that's one of the things that's keeping a wet blanket on top of the market, is the slow pace of export sales. Another thing that people are looking at, not just for cotton, but Mark talks about it too, is just the general pace of the economy. That's you got two or three economists, you got 7 or 8 opinions about how the economy is going to do and whether we're going to slip into a recession or whether or not we've avoided a recession by the beginning of interest rate cuts. The one thing that's clear is that recessions are bad for cotton demand, and that's what this slide shows you. That's what that blue line is. That blue line basically shows that there's a fluctuation between 6 pounds per person per year and 8 or 9 pounds of cotton per person per year. That's the average per capita consumption of cotton. Half a dozen shirts, 6 or 7 or 8 pounds of cotton per person per year. But the key thing to realize is that it goes up when the economy is growing, which that's the green line in percentage terms. That's the growth of the economy. That's the percent growth of GDP. When it goes down, that's a recession. You can see some historical recessions there. When it goes up, that's a boom period, and people tend to buy more home furnishings. They tend to buy more houses. They tend to buy more wardrobes. When they get new jobs, they tend to buy new wardrobes. So when the economy is humming along and people are working, and they have more income, they tend to buy more stuff, and they cut back on it during recessions. So then that leads to the million-dollar question. Well, are we in a recession? Are we going to have a recession, or have we avoided a recession? And if I knew the answer to that question, I'd be very rich and famous. So that's just something that we're going to have to continue to watch. Of course, they've been putting their foot on the accelerator to keep us out of a recession back during the pandemic, and then they accelerated too much and they caused inflation, which is year-over-year inflation is that blue line there. That's the percent higher cost of stuff this year compared to a year ago this time. That's what that blue line measures. And it got up to 9%, which was historically high. And then they started putting the Federal Reserve started tapping the brakes. That's what all those little plus numbers are. Those are interest rate increases to slow the economy deliberately, which we just said is bad for cotton consumption. But they did slow inflation, and now they're at a point where they think they can begin to, and in their words, engineer a soft landing and avoid a recession by stepping on the gas a little bit, which is what that half basis or half an interest rate, half of a percentage. That's what the -50 means. That's a percent cut in interest rates that they did a month ago, and maybe they'll do it once or twice more before the end of the year. Hopefully they do avoid a recession, but it remains to be seen. Meanwhile, as we're getting back to where I started, the red line is the December 24 cotton futures contract. And, we basically followed the seasonal pattern, which is the blue line there. We just followed it a little bit early. We peaked early. We had the big decline early. And we seem to have recovered a little bit here at the end because, again, those speculative hedge funds who had been selling the market to make a buck on the trends, they appear to be liquidating a few of their short positions by buying them back. And that's what's bumped us up to 73, 74. Whether we'll go much further than that, I think remains to be seen. In terms of old crop, for your growers who haven't harvested yet for the 24 season, there is some possibility for prices to, I think, get to 75, 76, 77. I don't know that it will go much higher than that, and I don't know that it would stay very long if it happened. So that's what I'm calling at the bottom a short covering rally. Those speculators could buy back all of their short positions, which would, that would bump prices some. I don't know that it's gonna. If they're the cause for a rally late in the fall here, I just don't know that it's gonna last very long. I mean, we'll take it, but I would use it as a selling opportunity. If I was a grower with bales to sell, I would use it as a selling opportunity because a whole bunch of other people are. There's going to be selling pressure if that happens. We'll finish by talking about next year. Based on relative prices with new crop corn futures, I think I expect that we'll probably plant roughly the same level. I don't see a reason for an increase in cotton acres planted. I don't see a reason for a big cutback either, just based on prices, which is how economists tend to think. So I expect that we're going to plant roughly the same level of acres. We're kind of forecasted to have possibly drier weather from a short-lived La Nina situation, and if that happens, we might have slightly above average abandonment, below average yield, but nothing drastic the way I'm looking at it right now. So I'm basically expecting us to pencil out something, again, 4-point-something million bales of ending stocks, which is less than a million bale change from the previous year. Here's my corn to cotton price ratio, which currently would predict that we'd plant. It predicts we'd plant 12 million acres. I kind of doubt that. I'm thinking we'll plant 11-point-something, which is similar to 24. And if we do that, and here's the forecast of NOAA showing a short-lived little dip for the temperatures in the Pacific, which gives us a short-lived mild La Nina, which tends to be drier in the wintertime. So we may start off next year, even if we plant similar acreage, we may start off drier. And if all that happens, I could pencil out some supply and demand numbers like I've got on the right here. Again, I'm thinking a little bit higher than average abandonment, a little bit lower than average yield, could still give us something approaching a 16 million bale crop. If that happens and we manage to export the majority of it, we can wind up again, like I say, with something under 5 million bales of ending stocks, which, that's not terribly bearish. That's kind of neutral. I would just expect us to have prices next year in the same ballpark of what we've seen in the 70s to 80s range. That's what we saw for the 24 season. That's what I'm expecting to find now. And Mark, that'll wrap it up unless somebody's got any questions.
All right. Thank you, John. Before I set my speakerphone down and we'll move on to the next presentation, any comments or questions for Dr. Robinson? I kind of want to chat here a little bit, or if anyone wants to unmute and ask a question directly, that'd be just fine. John, don't say anything at this second, so you'll be able to hang on and kind of hang around for us. You got to go.
I tell you what, I think I'm going to leave and then try to come back.
Yeah, maybe that'll help. All right, good deal. All right, well, thanks, John. Appreciate you being with us. Hope we made this work all right for everybody. All right. Well, again, I appreciate the assistance, the technical assistance there, getting Dr. Robinson online with us, and hope that you were able to hear that okay. And of course, these presentations will be recorded. And certainly, if you ever want a copy of these presentations directly, if you have programs or interests that these might be of assistance to you, just let us know, and any of us will be glad to email these presentations to you directly. If there's information here that you could use, or see something that perhaps we're not covering in any of these particular market sectors. If there's a question that you have, or that you know that your clients and producers would have that we could help with, please let us know. I'm going to go ahead and kick off on the grain outlook. Dr. Robinson may be able to be with us here. Or excuse me, Dr. Anderson is going to join us as soon as he can. But I'll go ahead and kick off the grain outlook before that, and we'll go ahead and get started with that. And let me go here. Hope you can see that okay. I start a lot of our presentations with this slide. Again, this kind of shows all those factors of supply and demand that combine to get us a grain price at any given point in time. And highlighted in red are some factors that have been, of course, certainly meaningful recently. but also I think as we're starting to shape up our expectations for 2025, particularly in the realm of exports, I want that to be the focus of kind of where I'm headed with my talk on grains today. If we're going to look at whittling down that stocks to use ratio, that pile of grain left over at the end of the year, I think the best prospects for doing that for 2025 are in the area of exports. And that means different things for different crops. Certainly for wheat, we're looking at export competition from Russia. Talking about the corn market, we're looking at export competition from Brazil. Rice, we're seeing a significant increase in rice exports from India this year, the second highest in history. India is the largest exporter of rice in the world, and certainly that has a big impact on the global rice market. So, I think that the factors of competition on the global stage matter a lot when we're talking about our grain markets. And one issue that we're facing in 2024 is that the factors of supply have been increasing greater than the factors of demand. And we'll walk through that for a little bit on corn and why that is so important and how those small changes in supply have such a dramatic price impact. Back to your Econ 101 textbook, there's a classic demand curve, which shows that as prices go down, we buy more stuff. The price goes up, you tend to buy less of it. Well, demand curves can have different slopes, and that's kind of a classic looking demand curve. Well, what if a demand curve looked like that? More of a vertical line. And that would be a demand curve that's more inelastic in that you can change the quantity just a little bit and it has a tremendous impact on price. And just to show that, there's a supply given those two different demand curves, and you've got a price based on that equilibrium condition at that point in time. Now let's increase the supply of corn, for example. And so you've got a bigger crop of corn. Well, if you have a flatter demand curve, the impact on price is relatively modest. If you have a more vertical demand curve, that impact on price becomes much more dramatic. It magnifies the impact of price for the exact same change in supply. There's the ending stocks of corn from 1969 through 2006 on the x-axis. And then over here on the Y is your season average farm price, the national average farm price of corn. And that would indicate a pretty flat demand curve in that we can have a huge change in that stocks to use ratio, but the price of corn only varied basically from $1 to $3 a bushel. Then enters the biofuel era, and then now we see a very small change in that stocks to use ratio results in a very dramatic change in the price of corn, such that we can kind of recalculate what that means to us. That is, we develop our price outlooks moving forward and put our balance sheets together, that a 1% change in the corn supply results in a 5% change in the price. And I'll show some information that'll play that out over the next couple of slides. This is the balance sheet for U.S. corn, the 2023 crop, where we were looking in May at the first estimates for 2024, and then the latest updates from USDA here for the 2024 crop in October. Last year was a record high corn yield at 177.3 bushels per acre. We thought that would be a record in May, and we've pushed that number even higher now with the October estimates, 183.8 bushels per acre. However, our production this year is still below a year ago when we produced that 15.3 billion bushel crop, and we're at about a 15.2. But with the larger carryover number, again, our supply increasing relative to our consumption, that pushes our total supply of corn to an all-time record high with this latest October estimate. What about the use categories? We're looking at domestic use, about flat, exports, about flat, total use, about flat. And so as we see those ending stocks numbers coming up, we've got a 2% increase in supply and a virtually no change in our use categories. So again, that 5-to-1 ratio, you would expect a roughly a 10% decline in price, and USDA's calculations here in October is in that ballpark, with corn prices down about 12% in 2024 compared to 2023. And so that's going to be an important calculation as we project 2025 crop here in just a minute. Crop condition ratings for this 24 crop have been really good. We've had 2/3 of the crop rated in these green categories, excellent and good. the entire growing season. And if you look at the crop condition index score that you can create from those percentages, I'm going to zoom in on that. We've been above average virtually the entire year, just now tailing off here at the end to what would be kind of a normal kind of crop condition index rating as we're moving into October. Last year, we had condition ratings below normal, still set a record high corn yield. It was below the trend estimate that year. If you looked at an average crop this year based on normal yield gains, going back over the last 50 or 60 years, you would expect a yield this year of 181. And again, USDA now projecting the U.S. corn crop is going to average 183.8 bushels per acre. Just an outstanding, amazing number for corn yields. And putting that in perspective, that charts those going back to 1980. So we've got about 44, 45 years of history there. And you can see the degree to which we're just bumping over what would have projected a trend line yield this year, again setting that all-time record high. The price pattern for corn has actually played out this year. Once we got past some early, perhaps marketing year or calendar year weakness, we've tracked about what you would expect seasonal tendencies to show in the corn market, with the exception, as Dr. Robinson mentioned in cotton, this thing is playing out about a month early. Shift that seasonal pattern back about a month and see how those red dots would line up with this year's pricing movements along in corn, and it lines up just about where we are, which I think gives me further confidence that we have actually set the harvest time low, that we've got that one behind us. Typically, we would have set that a week ago, but it does look like we set that late August, and now moving perhaps into a little moderate price strength in a kind of a post-harvest low rebound, and setting a stage for where prices may be headed for 2025. That days of use on hand at the end of the marketing year, that's my stocks to use ratio. As that number goes bigger, prices come down. As we've talked about many times in this presentation, 40 is a critical number when it comes to the corn market. If we're going to see higher corn prices, $5 corn and better, we need to get that carryover to use, that days of use on hand below 40. We're tracking now well to the right of that number, up here in the upper 40s. And so our price outlook for 2025 is going to depend largely on do we shift that number left or right, moving back toward that 40 carryover, or stay in this kind of area where we were with these very kind of a low price environment for corn in 2014, 15, 16, 17, 18, 19. Heavy carryover stocks, low prices, and we're tend to be back in that ballpark, coming down to these really good prices we saw in 21, 22, 23, and then now back over here in 2024. If you look at the U.S., again, that days of use on hand at the end of the marketing year, we've been increasing that over the last several years. And where are we getting back to? 14, 15, 16, 17, 18, 19. These relatively large carryover numbers that we saw back in that period. Globally, however, the foreign corn, take U.S. numbers out, and the rest of the world is seeing a tighter situation in their days of use on hand. But to this point, the increase in the U.S., given that we dominate the world corn market, that growing number in the U.S. has compensated for a declining number in foreign corn, and that world stocks to use ratio, world days of use on hand, has been very, very stable the last few years, around this 91, 92 day carryover. Very, very stable because of the big crops in the U.S., which kind of explains the flat prices where we are. But if there is a vulnerability and a variability in prices moving forward, it indicates that if we had a problem in the U.S. and the rest of the world is not making up the difference, it highlights the degree to which that where the U.S. is carrying the world corn market. And if we do have a production issue or a supply issue based on yield, based on acres, it could have a very dramatic impact on the world price of corn. So let's look at what I would project out for 2025. These are using some of my numbers, highlighted also by the FAPRI organization, the Food and Agricultural Policy Research Institute at the University of Missouri, and their baseline projections for 2025. Corn acres about the same. Trend line yield would be around 182, 183 bushels next year. But again, we would not be looking at a new record in corn production given those numbers. Because of the larger carryover that we're bringing forward, we are looking at still record supplies, however, without making a record crop. And that's the influence of those carryover stocks. And looking again at about a 2% increase in supply for 2025. If we're going to match that increase in supply on demand, I don't see the growth in the domestic categories for feed and fuel. If we're going to do it, we're going to do it with exports. And that would be the fact category we need, the factor of demand that would match the increase in use to that increase in supply to keep prices from pressing lower and perhaps balance out or steady these prices. They're not great, but at least stop putting that downward pressure on prices for another marketing year. And again, plugging that onto our chart as we saw before, it kind of keeps us in that same range, but perhaps sets us up for, again, with any kind of issues in production or supply in a major producing country, particularly in the U.S., that would give us some volatility in these prices and perhaps some better, more profitable marketing opportunities. So the factors I'm looking at for 2025, I agree. I think we still have a very significant headwind economically in the U.S. and globally for slow growth. I don't know that we're out of the woods in terms of recession, but it's still a slow growth, slow consumption kind of environment. When you look at the macro economy, obviously input costs relative to these prices are very, very high. Margins are going to be tight. And if we're going to get the factors of supply about even with factors of demand, it's going to be either a production problem, bringing down that supply number, particularly in the U.S., or strengthening in that export category. And I think that's our best shot at seeing that's something better on demand. So I'm looking at prices about steady, moderately higher, again, as we have just that normal uncertainty in January, February, March, hopefully get us some better marketing opportunities. But I think for grains, as I would agree with Dr. Robinson in cotton, the global economy, global trade, we need the most stable, undisrupted, undisputed environment we can for global trade and access to those world markets to move us forward with a better pricing opportunity when it comes to our grains and of course weather as that plays out in the next year. So that's what I brought to share with you today. Let me see if I can stop my sharing on that screen, and also be glad to take any comments or questions if anybody has anything for me right now.
I've got one. How important is China imports of, I know grain sorghum is important, soybeans, cotton, but what about corn?
You know, it's interesting that starting in 2020, one of the driving factors of that price trend we saw, prices going higher through 2022, was China's demand for feed grain. And they were importing record amounts of corn, importing lots of wheat that they were feeding to their livestock industry as well. That has come way, way down compared to those years. You know, in my newsletter, I'll track the top export sales for wheat and corn and grain sorghum. And obviously, yes, grain sorghum, China's the big buyer. China's barely a blip on the screen here for 2024, 2025, that they've really backed off on their purchases of feed grains and then wheat for feed in this current environment. So when they come in, they can be big, but them pulling out, that's big too. And that's what we're seeing right now. They're just not a big player in the current trade environment.
Thank you.
Okay, anything else? All right, well, hang around. David, good to see you. We will turn the floor over to you for our livestock presentation.
Well, thanks, Mark. I'm glad I made it.
Me too. Looks good. We can see your slides great. You're good to go.
Great. Hey, let's jump right in. I checked with Mark before we did this thing. I said, "You gonna say anything about drought?" And he said no. So I said, "Well, good. I'm going to," because you take a look at the drought monitor, and to me, this looks pretty ominous from a livestock standpoint. You look at all the areas that we have cattle and livestock, and I think this looks pretty ominous. Now, it may create some great weather for harvesting a lot of crops. Um, but this is pretty tough for, I think, for our winter grazing, for the pasture lands that we might have. I think you take a look at some of these areas where we would normally have wheat pasture, and it looks pretty tough out there. This is a grim looking map for the fall, to start the fall. I think where we may see some pressure from this is in some of our crop prices, or excuse me, our calf prices and feeder, our calf prices, stocker cattle prices over the last 6 weeks or so. I think some of the pressure there is from a lack of demand because of a lack of development of wheat pasture and winter grazing. And so I think this is I think this is pretty important. I think the other place this is really important is, what do you think our prospects are for rebuilding a cow herd with this kind of drought monitor map? I think those prospects don't look real great, at least depending on the path of this going forward. So I think this likely works to retard that growth also. And so, I think this is pretty important and worth keeping an eye on. I don't know, when I walk out here and drive through the country around here, it looks pretty darn dry. And so, and there's not a lot of prospects on the near term horizon for rainfall. So I'm going to lead with that, but I want to do about a little more on lamb than I would normally do. And I'm going to lead with that with about 4 or 5 slides. I want to start with prices. These are lightweight slaughter lambs, 60 to 90 pounds. I'm using a 3 market average here, obviously San Angelo, Colorado, and South Dakota. Take a look at this price slide. And by slide, I mean prices headed down. And I want to look at a couple of parts of this. One is the blue line being this year, the red line being a 5-year average. If we think about this red line really relating a lot to what we normally see for a seasonal pattern, we certainly had that seasonal pattern this year in terms of prices peaking back in the spring and declining since then. I think one of the impressive things have been that we've maintained prices higher than a year ago throughout most of the year until just recently. We've taken another big dive in prices. I think we have some real struggles going on in the marketplace for lambs. And the biggest part is that I think we're struggling against more production, a lot more supplies on the marketplace. That's what made those higher prices, I think, fairly impressive, that we maintained that, yet that seems to have disappeared. And I tend to put a little more of that on the effect, the impact of greater supplies on the marketplace. I want to show you another market. This is Sioux Falls. This really sort of reflects our Midwestern traditional, 100 to 150 pound slaughter lambs, that traditional heavy slaughter weight lambs, fall lambs going to market. Take a look at that slide in prices, where we might normally expect prices to decline from, say, May to the end of summer, but we've taken a much larger than normal decline in prices. We're now below the 5-year average. Those are some pretty dang low prices for lambs going to market right now. Again, I think we have a lot of supplies of lamb on the market, pressuring these lower. I think it may suggest too some strategies by the relatively few large buyers in terms of perhaps what they think their orders are coming up into the fall. But I think this is pretty ominous on that side too, as we look at prices continuing to go down. And where are we going to get the impetus for this, for a little bit of increase in price late in the year that we normally see? There doesn't seem to be a lot of that yet, except for one area. Let me show you lamb slaughter. This is total sheep and lambs going to market. And what I would highlight is really from, say, May, really through Labor Day, we had more lambs and sheep going to slaughter than we did a year ago. In fact, for the year, slaughter is higher than a year ago. Take a look, though, at the last 4, 5, 6 weeks, where we're basically right on top of where we were a year ago. I think that gives us some hope that maybe that we're narrowing that gap in terms of slaughter to where we were a year ago, and maybe bringing that production down a little bit. Now, I say that gives us some hope maybe for some seasonal increase in prices, particularly with some fall demand that we might normally see. But the problem is that every one of those lambs that's going to market, our weights are actually higher than they were a year ago. So while slaughter's pretty flat, if I look at production, production's actually running bigger than a year ago, really driven by weights. So it just takes 2-3 pounds of dressed weight to make up for a bunch of those lambs going to market. So we continue to struggle with more domestic production than a year ago. And if I take a look at imports, and this data came out last week, our imports are well above where we were. And in fact, I think I went back through the data, and this July import data at 29.5 million pounds that's about the biggest monthly imports I could find on record. I found another 29.3 million pounds back in 2021. So our imports are big, driven by really higher prices here, making this an attractive market. And I think some stronger dollar concerns as well, making this an attractive market. And they've got supplies to sell, and we're buying them. And so they're coming into here. So if we put together more foreign supplies with more domestic supplies, we're pushing, in the third quarter, some 10% more lamb on the market than we did a year ago. And so why we've seen lower prices, just a heck of a lot of supply. And so I think this is a real problem on the price side for this industry. So I thought I'd start with that and go a little more in depth than I normally do. That's certainly a lot more than I usually do on this, but it's on my mind because I was writing an article for the American Sheep Industry Association newsletter, and I sent that off to them at the end of last week, and so I think there's been a little more on my mind, so I thought I'd lead with that. Now let's jump into cattle a little bit. You know what? If we look at our cull cows, they've certainly made the turn seasonally to declining prices as a few more animals go to market because it's fall and we cull more animals this time of the year certainly on the beef side. But also we're past kind of grilling season ground beef demand too. And so we get a little bit of supply and demand action. We certainly peaked mid-year, roughly around 125 for this type of cull cow. Higher quality ones were certainly higher priced, but even those have begun to come down. But still much better prices than we had a year ago. Certainly better than that 5-year average. But, our seasonal expectations in terms of cow prices are holding. If I was going to look further ahead to next year, I think given cow slaughter numbers, what I've got projected for replacements, I've got a smaller cow herd next year than this year on the beef side. And so what that really tells me too is tighter supplies of cull cows, continued pressure for higher prices on the cull cow side, but also on the meat side too, really with higher prices. And so the pressure's on for higher prices next year. Take a look at those calf prices. We've certainly declined on this 500 to 600 pounds sort of southern plains. We're about where we were a year ago. I think some of that weakness is coming from two areas. One, from really fed cattle and feeder cattle supplies and prices, with some lower feeder cattle supply prices. Get tongue-tied here. With some lower fed cattle prices, I think we've got some pressure here. But let's go back to that drought monitor. I think I have some expectations of stocker calf demand for wheat pasture that it sure looks like it's with very little development. I think we've likely cut into some of that demand for calves. And so the demand that's there is probably more likely to head them to feedlots more directly than some winter grazing if we look at that drought map. So, some of the weakness is coming from a couple of different spots. The demand from higher up the chain, but also maybe a little more supplies going with some poorer range and pasture conditions. On the fed cattle side, we've actually seen some rebound in prices over the last 4 or 5 weeks. I wrote this up for a newsletter called In the Cattle Markets, and what we've got going on is basically a slow increase in prices, kind of building in the fall as we often do seasonally, is moved to some higher prices. I think we've got some movement there to some higher prices. It's slowly building. So we talk about 187, 188 in the market last week for fed cattle. That's better than where we were at last year, but it's certainly not the almost $2 that people thought 4 or 5 months ago we would be at. But still, these are not terribly low prices for fed cattle. But again, but starting to build a little bit. I thought I'd include the cutout because we did see last week cutout increase jumped. We had some by the end of the week. I think about 312, $312 per hundredweight, or $3.12 per pound in the cutout. Certainly seeing some increase in the cutout and some increase that we might normally see seasonally. But the big thing in terms of the meat side, or the beef side, I should say, if we take this cutout being right on top of where we were last year for the last couple of months, really some concerns about weakness and where is that coming from? Why aren't these prices higher? And the key is that we've been producing more fed beef this year than we did last year. And a heck of a lot of that is driven by steer dressed weights. We hit almost 950 pounds 2 weeks ago for dressed weights. That's a record high steer dressed weight. Heifer dressed weights were almost a record high. And so if we look at the same number or more cattle on feed than we had a year ago at record weights, then and actually as much or more fed cattle slaughter as we've had a year ago in some weeks, we got more fed beef on the market. So why is the choice beef cutout struggling? Because we have more choice beef on the marketplace. And it's hard to push prices higher with more supplies. And so I think that's really an overriding factor that continues with us on the beef side. It's just simply total supplies of beef that we've been producing more. That these weights came down, gosh, that's a good thing, I think. In terms of total supplies and getting to some higher prices, some rebounding prices on the producer side. Let's get these weights down a little bit. So we'll see how that develops, but still they're well above where we were a year ago. I think the other thing in terms of total supplies that's pretty important is trade. The data came out last week, like I showed on the lamb side. We got this on the beef side with some very large beef imports. Well above where we were a year ago, and certainly the 5-year average. We're importing more beef because most of what we import are lean beef trimmings to go into ground beef. And with tighter cow supplies, tighter non-fed beef production, certainly the price incentive is for more imports. And so we certainly see that going on here. I think that's pretty important to take note of. We are importing more beef by volume than we're exporting. Over the last decade, we've tended to turn that around where exports were bigger than imports. We're back to the way it used to be with more imports than exports, but certainly the mix of products are pretty important. I close with this one last slide of retail beef prices in the Consumer Price Index data that came out late last week. Retail beef prices were there. Here's the choice beef price. It actually declined a little bit. The all fresh continued to increase to new record highs. The choice came down a little bit, but you take a look where the cutout was with the cutout declining. There is a relationship between wholesale and retail prices, and that probably leads us to a little bit lower price, but still those are very high prices. I started to for this week, but I think I'll save it for next time. I want to do a comparison of if we look in the wholesale market for ground beef and chicken breasts. You may have noticed that McDonald's announced last week that they're rolling out a chicken Big Mac. They have tested that thing in some other markets and they're rolling it out nationwide. And I think we really ought to think about considering the relative price differences between a chicken breast and ground beef. And I think that relative price difference, boy, that supports some of these movements more to chicken in this market where they're rolling that out as an alternative. That's likely kind of an important factor in rising wholesale prices for chicken breasts because McDonald's is pretty dang big. They sell a whole bunch of chicken Big Macs, and you better have a lot of supplies set aside for that. So we probably get a little boost in the wholesale market for breast because of that going forward. But these are high prices, and I think we see competition in the marketplace. And I think that Big Mac thing, certainly at the fast food retail end of things, is a I think that's a pretty important development in sort of fast food places trying to figure out what they're going to do with expensive ground beef and how they can roll out new products to try to stay competitive. Because it's the fast food places that their costs per meal have gone up much faster than what we would see at the grocery store. And I think there is evidence of people buying more at the grocery store to cook at home rather than those places. And it's really driven by by the rate of growth in prices. So I'm going to quit there. See if I can end this show. Maybe stop sharing my screen. And y'all got any questions for me?
All right. Thank you, David. Yeah, take a second here if you want to put something in the chat, or if you'd like to unmute and ask your question directly while you're thinking about that. David, that carcass weight slide still just, I've seen it several times now, and it just amazes me. A 950-pound carcass. So what kind of live weight animal is coming off a truck? 1,500 pounds?
Oh, so I'm going to take my handy dandy little old calculator here, and let's do 950 divided by 0.635 is sort of a yield. That gets me a 1496.
Good night.
Average live weight. Average.
Good night.
Think about the top end and the bottom end. So what's driving those heavier weights? It's keeping cattle on feed longer.
Yep.
So it's days on feed, and more days on feed runs us to these heavier weights. And so, and you know, I think cheaper corn lends to that as well, but I don't think that's the primary factor. Longer days on feed have been going on longer than that.
Yeah.
But that does contribute to that as well, I think. And also good weather.
Yeah.
I mean,
yeah.
I think there's been plenty of evidence of, you know, good feeding weather practically all year that has led us to some very good performance and much heavier weights.
Which we need. If we have, you know, fewer animals out there, we need more of them eat more corn to pull out our corn supply. That's good.
Yeah, and I think if we looked across all of our livestock species, all of them are feeding animals or producing animals to heavier weights. Cattle's not alone in that. The growth in chicken production, a lot of broiler production is in heavier and heavier weights because we bred chickens to boost breast meat yield, because that's what consumers really like in the U.S. We're going to eat chicken sandwiches and chicken nuggets and tenders and everything else. It's really that breast meat thing that drives it. Luckily, people like wings too. So that taking a worthless product and turned it into something pretty darn valuable. But same on the hogs, heavier weights. And so we see that across all of these species.
You know, it seemed like a few years ago we heard concerns of at the packing plant, these big animals, the chains weren't high enough off the floor. And are these just bigger carcasses in girth? Maybe not necessarily in length. Is that still an issue in the industry? Do you hear that kind of noise anymore?
That's still a problem.
Yeah.
It's a problem all the way from that. But we've had a lot of plants trying to refurbish and retool some things to be able to handle these bigger carcasses. But that's been a problem for a long time. And it also leads us to other problems on the meat side, because you'll hear restaurants or food service people complain about the size of the cuts. They're too big for the box, but they're also too big for the plate they're trying to sell people. And to get like a steak at the thickness that people like, that it looks like it's supposed to, yet the thing is so big that nobody can afford to buy it. And but you know, people have complained about that as long as I've been around doing this line of work. And so that's getting to be longer than I want to admit. and so, you know, that's been a problem forever, but the economic incentives are for bigger carcasses, heavier carcasses, more meat per animal. That's where the economic incentive is. So how do we deal with the other problem? We get a sharp knife out and we see what we can do. And I think that's really how, I think that's probably the best explanation. But the economic incentives keep us going in that direction. We know there's economic cost to these stakes, the cuts being too big. There's a really good paper by one of my buddies, Josh Maples at Mississippi State, that was part of his PhD dissertation. A really good paper on kind of the economic losses to that. But the problem is the economic gains on the other side outweigh that. And so we keep going to heavier weights.
There you go. Yeah. Fascinating. Yeah. Trends in that industry that certainly have implications over kind of where we watch on the grain stuff. So very good. Anybody else? Comments, questions before we wrap it up here today? John, I think we had your speaker working. Anything else you want to comment on before we let you go?
Yeah.
Sound great now.
I'll give it again if people want to hang around.
Oh, in that case, I'm glad I missed it.
Again, we appreciate your participation and taking time out of your valuable schedules to be with us for these programs every month. Anytime, if you got a follow-up questions, if you need copies of these presentations, something we're missing that you want to hear about, please let us know. We're doing this to provide the supportive information that you need where you are with your producers, your clients every day. And so if there's something we can do to expand on that, that's what we want to focus on. So David, John, thank y'all for being here on behalf of Poncho that couldn't be with us today. Thank you all. And if we don't hear from you before then, we'll look forward to seeing you next month. Thanks, everybody.
Thanks.
Y'all take care.
See ya.